Many people invest in the S&P 500 index because of the attractive high growth and fantastic market returns it consistently provides. This index consists of the 500 largest US companies that are weighted within the index through market capitalization. This means that the bigger the company you are, the larger share of the index you take. Over the past 5 years, the S&P 500 index has given over 90% returns, meaning that you would have almost doubled your money had you invested a lump sum 5 years ago. People commonly invest in this index by purchasing an ETF or exchange-traded fund that tracks and tries to replicate what the index does to provide near identical market returns. And ETFs will do this by pooling together investor money and then making purchases of shares on a large scale across all 500 companies in the weightings as determined by the index. Currently, Microsoft is the largest company within the S&P 500 index, accounting for 7% of it. So every time you purchase an ETF that tracks the S&P 500, 7% of the money is invested in Microsoft. These are called passive ETFs and normally come with chief OCFs or ongoing charge figures. And an ongoing charge figure is also known as a total expense ratio, TER. The OCF or TER is the fee that the fund manager levies for administration of that ETF. You can also get what are known as active versions of ETFs. If investing in an active ETF, you pay a fund manager to do more work to try and beat the market returns that an index provides. I'm not going to talk about active ETFs in this video, as in my opinion, they are too expensive, riskier, and in a majority of instances provide lower returns than their passive counterparts would. Before we look at ETFs that have significantly outperformed the S&P 500 index, I firstly want to look at an ETF that tracks it to provide context of the index and for comparison purposes as we go forward. Being such a popular index with investors, there are so many choices when it comes to passive ETFs that track the S&P 500 index. The largest and most popular is the iShares Core S&P 500 UCITS ETF with the ticker of CSP1. And this ETF, just like the S&P 500 index that it tracks, has provided returns in the region of 91% over the last 5 years. And this is similar to other fund competitors such as the Vanguard S&P 500 UCITS ETF with the ticker of VUSA. People choose to invest in ETFs rather than individual stocks and shares for the added diversity that such investments bring. Diversity is a great tool to help manage concentration risk. Rather than putting your money into one company, you invest in them all, thereby benefiting from the growth of the companies that do well and offsetting any losses from poor performers. But when choosing an ETF, you should not assume that you'll get the diversity from it that your risk profile demands, and you should do your research as to the concentration risk that your ETF of choice is exposing you to. For example, if you invest in the iShares Core S&P 500 UCITS ETF, you are getting an investment that can be described as diverse, as you are investing in a large group of companies across many sectors. But an argument that some might make to counter this is that by investing in an ETF that tracks the S&P 500 means that you're investing solely in the US market, discounting other companies within other regions globally. But given that the US has historically been the biggest player on the global stage, with about 60% market share at present, if the FTSE All-World Index is anything to go by, you might conclude that the 60% global share is diversified enough, but this should still be a consideration for you. In investing, to obtain higher returns, you have to accept that you need to take on more risk. And although considered acceptable and a popular choice with investors, you do this to a degree by investing in an S&P 500 ETF rather than a globally diversified one. And diversity will continue to be a theme during this video, as you will see concentration risk increasing as diversity reduces, with ETFs that outperform S&P 500 funds to provide higher returns. Remember that this video is not financial advice, it's for educational purposes only. The ETFs featured in this video today are for illustration purposes only and not my recommendations. Don't fall into the trap by thinking that an ETF's past performance is what you will get back in the future. And use the data I provide here as a guide only and not as an accurate indicator of what will happen in the future. Remember that your capital is at risk and you may end up getting back less than you put in. So let's take a closer look at the iShares S&P 500 ETF to get a better flavour of how the index is weighted. This ETF is an accumulating one, meaning that any dividends paid by companies get automatically reinvested without you having to do anything. It is therefore less maintenance and lower cost also, with an ongoing charge figure or total expense ratio of 0.07%. So firstly, if we look at the top 10 companies, you will see that they account for nearly 36% of the index. And unsurprisingly, given that most of the top 10 come from the technology sector, tech takes up a similar proportion of this index also at 35%. So this index is 100% US based, with the top 10 companies taking up over a third of it, and who are predominantly from the tech sector, which also takes up over a third market share. So there are potential risks here, with a concentration towards fewer companies within a specific sector. Technology has been the driving sector for global growth over recent years, with new gadgets constantly being introduced to the market, and innovations such as AI constantly pushing it ahead. But there could come a time when technology stops delivering and demand for it falls. And this could mean that the top companies stop growing or even start to lose dominance within the market. As this sector is more heavily concentrated within the index, you could see bigger drawdowns in your portfolio than you might see with globally diversified funds, where technology has smaller holding. And concentrating your investments more in a smaller amount of successful companies, in the fewer sectors that are delivering the biggest growth, is the risk that you have to take to get those higher returns. Given that the S&P 500 has another 490 companies spread across other sectors, its diversity is arguably sufficient enough to take an edge off any large falls that the tech sector may or may not bring, as other companies within the index perform better to take up the slack. To seek higher returns than the performance of an ETF that tracks the S&P 500 index, we're going to have to take on greater risk through reduced diversity, more volatility in price movement, and greater drawdowns, which is what you would be doing if you invested in an ETF that tracks the Nasdaq 100. The Nasdaq 100 is a group of 100 companies, predominantly US based, that are again weighted on a market capitalization model. And the Nasdaq index is sector diverse, in that it consists of 8 sectors, excluding financials. And on this occasion, using a popular ETF that tracks the Nasdaq 100, which is the Invesco Nasdaq 100 UCITS ETF with a ticker of EQQQ, we can see that the top 10 companies account for over 50% of this index. And unsurprisingly, once more, so does the tech sector. On this occasion, the top 3 companies of Microsoft, Apple and Nvidia account for 25% of the index. So you can see more concentration in fewer stocks and the reduced overall diversity that you are dealing with here. There would certainly be a shock to your portfolio by investing solely in an ETF that tracks the Nasdaq 100, should one of those 3 companies have a bad day, with there being less weighting from the remaining companies to help smooth out price volatility or to prevent large drawdowns. But on the positive side of things, when this index does well, it does really well. And comparing this with the last ETF we looked at, the CSP1, you can see the higher rewards that you get for that additional volatility that you take on, with returns of 143% over 5 years. EQQQ is a distributing fund with an OCF or TER of 0.3%. This isn't the cheapest ETF out there, but I've chosen it because it's been around long enough to measure 5-year performance data. An alternative one to this one is the XTrackers Nasdaq 100 UCITS ETF, which has the ticker of XNAQ, and I mentioned this one as an alternative as it's accumulating and it has a lower TER OCF of 0.2%. But if 143% 5-year returns are still not sufficient for you, our continuing research means that we'll have to increase concentration risk and reduce diversity further by focusing more on those fewer successful companies from the tech sector. The S&P 500 capped 3520 Information Technology Index tracks those largest tech companies from the S&P 500 in a reduced group of 67 holdings. The index is market cap once more, but on this occasion also imposes a maximum cap on individual stocks, currently at a little less than 35%. This is to prevent the largest companies being too dominant and to maintain some sort of balance within the index. And that diversity is one of the main reasons why we invest in ETFs at the end of the day. Interestingly, 1 or 2 names are missing from this index as not meeting the index criteria for the definition of technology. So don't be surprised to not see Alphabet, which is the parent company for Google, or Meta, the owners of Facebook and Instagram, anywhere within a list of companies in this index. The iShares S&P 500 Information Technology Sector UCITS ETF with a ticker for IITU tracks this index, and this one is an accumulating fund with an ongoing charge figure of 0.15%. The top 10 occupy a significant 75% of this index of tech companies, with the top 3 companies of Microsoft, Apple and Nvidia accounting for 60% of it. You really do lose a lot of diversity in this fund, and could see very large drawdowns in your portfolio if one of those 3 companies does badly or the tech sector does badly as a whole. The upside to this is that your gains could be fantastic if things go well, with this ETF having provided 199% returns over the past 5 years. That is tripling your money if you invested a lump sum 5 years ago. But looking at the short-term performance of all 3 ETFs featured so far, You can see how much price volatility IITU especially has. If IITU was to be the only ETF in your portfolio, then prepare yourself for a roller coaster ride. So far, we've looked at ETFs that are dominated by tech companies to find funds that trounce the performance of the S&P 500. And this next one might be the best of all. Did you know that the tech sector subdivides into more specific subcategories, with some of those biggest being semiconductors, software, networking, internet, and hardware? And we can find potentially higher returns again by concentrating on the semiconductor space with an ETF that tracks an index of semiconductor companies. And that is the MVIS US Semiconductor 10% Capped ESG Index. And this index is tracked by the VanEck Semiconductor UCITS ETF with a ticker of SNGB. This is an accumulating fund with an OCF TER of 0.35%. The top 10 companies, again, account for a large 75% of this index. So this one, just like IITU before it, is very concentrated. I'm not going to make an argument here that this is a diverse fund, but at least there's a 10% cap on how large any one company can be within the index to maintain some balance. Also, the top 3 companies' concentration is a lesser 30%, and the index is more diversified regionally, with the US accounting for 77%, but with big companies such as Taiwan Semiconductor and Dutch company ASML being within the top 10. As this is a newer ETF, performance data only goes back to the 3rd of December 2020, but it still managed 120% returns over this shorter period of time. So with this one, you would have more than doubled your money if investing a lump sum 3.5 years ago. And you can see from the chart that it has outperformed all of the others featured in this video over that period of time, and significantly so in relation to the S&P 500 and Nasdaq. Having now seen all of these funds, are you now rushing to sell your S&P 500 or global ETF in pursuit of the higher returns that these ETFs can provide? Maybe you have now started to experience that fear of missing out. Well, before you do anything, take a look at one last graph, and this shows the 30-day market price data for all 4 ETFs. And from this, you can see much more volatility that you get from these funds as tech company concentration increases and diversity falls. That increased line movement equates to the value of your portfolio if you invest solely in one of these ETFs, and you could experience massive drawdowns in the short term. If a long-term investor, then you may not be worried about these short-term market movements, but it's still reasonable to say that investing solely in one of these funds featured here would be an interesting journey that you would definitely need to have a stomach for. Add to the mix bad economic news or a negative geopolitical headline, and your stress levels could be tested as your portfolio's value plummets amongst the noise of market panic. Depending on your tolerance for risk, that heightened level of anxiety could cause you to sell out. If you are a bit more cautious with less of a tolerance for risk and you just want to sleep at night and not be affected by all that economic noise on your long-term investing journey, then a more gentle and less risky compromise might be to adapt a core satellite position. This is having a majority core position, maybe 90% or more, invested in a diverse global or S&P 500 ETF, which you just leave alone and don't touch. That remaining 5 or 10% can then be used for satellite positions, where you can seek those higher returns from one of the funds featured in this video, or from a fund of your choice. Doing things this way exposes you to the higher returns that those funds could provide, and will hopefully, to some extent, pacify the fear of missing out that you might be experiencing, whilst ensuring that you remain diversified enough to keep your investment journey less stressful and not to risk your overall portfolio. That said, everyone has their own individual circumstances. What seems like a reasonable path to me in taking that satellite approach might feel completely wrong to you. This video is not designed to influence what you do, and you should take your own circumstances into account before making any decisions. And this might include seeking the advice of a suitably qualified professional if you're unsure of what you're doing. Whatever you decide to do, please make sure that you do your research and think carefully about taking on any additional risk before taking action. Thanks once again for watching.